World coffee production is dominated by Brazil and Vietnam. Between them, they account for 60% of global output of Arabica and Robusta. Although Africa is the origin of coffee, and it has several large producers, obviously Ethiopia, Uganda, Kenya are the best known, its share of world production is actually small. If we look at Arabica, Latin America dominates production. 8 out of the top 10 producers in the world are from the region, and Latin America accounts for just under half of the world output of Arabica. The only significant producer outside Latin America is Ethiopia, which produced 4.4% of world supply in 2012-13. Robusta production is more evenly spread around the world, and 4 African countries feature in the top 10, notably Uganda in East Africa, Côte d'Ivoire in West Africa. But together, they still represent just 3.8% of the world total. As a result, Africa's coffee producers are at the mercy of the international market, and many have had to develop niche export markets, notably in the specialty sector, in order to prosper. So how does Africa's coffee production break down? Well, what we can see clearly from this map is that East Africa dominates production of Arabica. Ethiopia is the world's largest Arabica producer, the world's third largest, with 6.3 million bags of output in 2012-13. This reflects the fact that Arabica originated in Ethiopia, and its production and consumption is a major part of the Ethiopian culture. There's also significant production in Kenya, Tanzania, and Uganda, but Rwanda and Burundi are suffering long-term decline in their coffee sectors, reflecting land pressure and the exodus of farmers to more profitable crops. Also, my apologies if you're from Rwanda and Burundi, I got them the wrong way round. There is also modest production of Arabica in West Africa. But when it comes to Robusta, the production is more evenly spread across Africa, and this reflects a pattern around the world as well. 5 African countries feature in the world's top 10 Robusta producers. Of these, Uganda is by far the most important, with 3.2 million bags in 2012-13. Together, Uganda and Ethiopia dominate Africa's coffee sector, producing over half of Africa's coffee output. Together, they helped drive a 16.6% increase in African production last season to 18.4 million bags, a 13-year high. Looking to Africa's middle-ranking producers, Côte d'Ivoire is re-emerging as West Africa's leading coffee exporter after the disruption caused by the 2010-11 political crisis. In contrast, the decline in Kenya and Cameroon's sectors is set to continue, as the governments of both countries struggle to implement painful reforms needed to revive the sectors in the face of strong international competition. In Kenya, the decline is primarily the result of a lack of investment in new varieties and irrigation, the regulatory environment, and particularly rising pressure from urban development, which is eating into the coffee zone, and of course other crops as well, particularly tea. While in Cameroon, low farm gate prices and the lack of financing for inputs are driving farmers out of coffee into other crops. In terms of micro producers, Liberia is one to look out for as a specialist origin. Although the country produced just 650 tons of coffee in 2011, Liberia is the origin of a third variety, Liberica, which could compete with Robusta and Arabica. Varieties of Liberica have been cultivated in Southeast Asia for some time, and there is a clear opportunity to develop a specialist Liberian brand. When it comes to consumption, Europe has historically dominated, accounting for around a third of all coffee consumed. Latin America has recently displaced the USA and Canada as the next largest consumer, while the strongest consumption growth rates are in Asia and the Middle East. In contrast, Africa is a marginal consumer of coffee, which is primarily viewed by its producers as a cash crop for export. Ethiopia and Algeria dominate consumption, accounting for 3/4 of Africa's total. In Ethiopia, this reflects the centrality of coffee to the Ethiopian culture, with 42% of national production being consumed domestically. North Africa also dominates coffee consumption, again reflecting cultural tastes. The only notable consumption in Middle Africa, other than Ethiopia, is Côte d'Ivoire and Madagascar, but this is on a small scale. Exports of African coffee are dominated by Ethiopia, primarily Arabica exports, and Uganda, primarily Robusta, with other producers exporting both beans. Exports of coffee from Ethiopia averaged $780 million per year in 2012, 40% of Africa's coffee exports during this period. The value of exports has risen steadily each season, and this is despite the weakness in international coffee prices since late 2011, and it reflects rising volumes and the growth of specialty coffee exports, which command a premium. Uganda's coffee exports have fluctuated from season to season, primarily reflecting the international price for Robusta, and the country has around an 18% share of Africa's coffee exports. Kenya and Tanzania's coffee exports have steadily grown, but they are small, and Côte d'Ivoire is re-emerging as the most important exporter in West Africa. In Sub-Saharan Africa, the only notable importer of coffee is South Africa, with 525,000 bags in 2012-13. This reflects the high level of domestic consumption and the lack of coffee-growing regions in the country. Other African countries do import some coffee, but nearly all of this is for re-export. For example, Kenya and Tanzania re-exporting Rwanda and Burundian coffee. So where is this coffee going? Well, the EU remains by far the most important off-taker of African coffee. In 2012, the EU imported $1.3 billion of coffee from Africa, or 61% of the total. The leading European importers were France, Switzerland, the UK and Portugal, whose roasters use the beans in blends for European and the world market. The USA and Canada accounted for around 12% of imports. And then Algeria stands out as North Africa's leading consumer of African coffee, most of which comes from Côte d'Ivoire, and Japan as Asia's most important consumer, mostly from Tanzania. But if we look at individual countries, the picture is slightly different. Kenya and Tanzania are clearly focused on developed markets. 78% of Kenya's coffee and 51% of Tanzania's coffee are exported to Western Europe. This reflects long-standing historical ties and both countries' failure to significantly develop new export markets for their coffee. As a result, the former colonial powers of both countries are the second largest importers of their beans, the UK for Kenya, Germany for Tanzania. But other African producers are developing niche markets of their own. Although Western Europe remains their largest market, there are other markets growing in importance. 14% of Ethiopia's coffee goes to Saudi Arabia, a long-standing commodity flow, and Ethiopia is targeting new markets in China and South Korea. 18% of Uganda's coffee goes to Sudan. A large proportion of this is probably re-exported across the region through informal trade corridors spanning South Sudan, northern Kenya, and Somalia. And a full 2/3 of Côte d'Ivoire's coffee goes to Algeria and 20% to Spain and Italy, reflecting these countries' preference for the Ivorian's more bitter Robusta variety. When it comes to the trading of coffee and the purchasing of coffee, the trading houses and the multinational roasters dominate. On a global scale, Kraft and Nestlé purchase around a quarter of the world's traded coffee. There is no breakdown on how much African coffee they specifically purchase, but African coffee, both conventional and specialty, is likely to be evenly spread among them. The world's 5 top coffee traders account for 40% of traded volumes. That's the bar chart on the right. Again, there's no breakdown of the share of their share of the African coffee market. But what is clear is that those top 5 names, Neumann Cafe, Ecom, Olam, ED&F Man, Louis Dreyfus, appear regularly in African deals, and it's likely that they have an even larger share of the African market than they do globally. The dominance of these trading houses is being felt not just in Africa's coffee sector, but also in its cocoa, cotton, sugar, palm oil, and grain sectors. This is choking off the emergence of a new generation of African coffee traders and is constantly raising the bar ever higher for new entrants. The key for Africa to break this dominance is the certified and specialty coffee market. Over the past decade, this has grown from a niche market into a major component of global coffee sales. In 2012-13, the world's 3 leading certification labels, UTZ, Fairtrade, and Rainforest Alliance, certified a combined total of 1.5 million tons of coffee, equal to 22% of world supply. In addition, demand for certified coffee has trebled between 2007 and 2011, much faster than conventional coffee consumption, which grew by just 8% over the same period. The world's coffee majors are under huge pressure to meet CSR standards, and they have pledged to source 100% certified beans by 2020. This is fundamentally altering the way that coffee is produced and marketed in Africa, and it is a great opportunity for African producers to establish global brands and secure a larger share of the market, particularly the high-quality end. The market leader globally is UTZ. It accounts for around half of all certified coffee produced in the world, with Fairtrade and Rainforest Alliance each accounting for around a quarter. However, the strength of each scheme varies by region. UTZ tends to dominate in Brazil and Vietnam. Fairtrade and Rainforest Alliance are strongest across Latin America. All three labels operate in Africa, but as you can see from the bar charts where blue represents Africa, Africa is a marginal contributor to global certified coffee supplies. Total certified production reached 104,000 tons in 2011, 6.9% of the total. The highest African outturn was for Fairtrade, which works with over 300,000 smallholders on farms smaller than 1 hectare. It produced 43,000 tons of certified coffee in 2011, around 11% of its global total. Rainforest Alliance operates in Ethiopia, Kenya, Tanzania, Togo, Uganda, and Zambia on 150,000 hectares of certified coffee plantations. That's around a quarter of the scheme's land under cultivation. However, owing to low yields, Fairtrade's 76,000 African farmers produced just 28,000 tons in 2011, 8% of the scheme's global total. UTZ coffee production in Africa remains marginal, just 33,000 tons in 2011, or 4.5% of its total. And then 4C Coffee Alliance has 17 licensed units operating in 4 African countries, of which 10 are Rainforest Alliance. The low level of coffee certification in Africa reflects numerous factors. Perhaps the most important is the predominance of smallholders in Africa's coffee sector. Nearly all of them sell their beans to local buyers or to aggregators, which makes segregation and tracing the beans almost impossible. And these farmers tend to lack the business acumen and, should I say, the ruthlessness of some of their Vietnamese competitors who've seen the margin to be made on certified beans and have aggressively responded to market and responded to buyers. In addition, the 3 main certification schemes have long focused their activities elsewhere. UTZ on Brazil and Vietnam, Rainforest Alliance and Fairtrade on Latin America. And African governments and regulators have been focusing on developing conventional coffee for export rather than on boosting certification. But the situation is changing, and it is changing by the day. This year, numerous certification schemes with strong support from governments are being rolled out across Africa, and they could transform the sector. The specialty sector in Africa is also growing in strength. African specialty coffees are of high quality, and they often come from micro-environments which give them unique taste characteristics. African specialty coffees have traditionally been Arabicas from Ethiopia and Kenya. These 2 countries had a 12% share of the world's specialty coffee market in 2012. But there is also pressure from industry stakeholders to develop Robusta specialty brands. And we've already heard today that Robusta is not necessarily lower quality. It's all about developing higher quality varieties. If we look at the specialty sector in Africa, a number of companies stand out who export specialty coffee, often roasted as well and in vacuum packages. We have Kiagalanyi coffee from Uganda, Tika Coffee Mills from Kenya, Mzuzu Coffee from Malawi, Terra Nova Coffee from Zambia. Many of the larger trading houses also own their own certified production. For example, Ecom and Neumann Cafe own UTZ certified coffee farms in Uganda. Certified and specialty coffee will become increasingly important to the African market, with a focus on improving bean quality and extracting more value from the production chain. But It's not plain sailing in the certified and specialty coffee market. There are many issues, and I'm sure there are a lot of different opinions here about the pros and cons of certification. But two in particular stand out to me as being big issues, both globally and for Africa's coffee sector. The first is mass balancing. Is everyone familiar with the term mass balancing? Okay, fine. There will be some people who have, because I spoke about it at a conference late last year, and there were a few people there, unless they've forgotten. This is perhaps one of the greatest kept secrets of the coffee traders and coffee roasters. Basically, mass balancing results from the realities of operating a coffee value chain which stretches over thousands of miles and involves dozens of actors. Given the high cost of segregating coffee beans through the value chain, which means separate facilities for washing, storing, transporting, roasting, many companies that want to use certified coffee opt for mass balancing. Under mass balancing, they purchase a certain volume of certified beans during the year, say 15% of their total production, and they can prove this with the certificates. Then they brand 15% of their coffee products as certified, but they use whatever coffee is available, as the certified beans have not been separated through the value chain. This means that if you buy a packet of fair trade coffee in the UK, odds are that little or none of the coffee in the bag is actually certified. Rather, you have contributed to certification of coffee somewhere in the world. It's quite shocking, actually, when you think about it. Traders and roasters have defended mass balancing. Okay, they argue that they intend to source all of their beans from certified sources eventually, and it makes no sense to invest in separate value chains now if they're just going to abandon them in 10 years' time. But this hasn't been communicated to consumers, who may not be so understanding. There is a risk of serious damage to the reputation and branding of certification schemes if this issue is taken up by consumer groups, because there is an argument to say it's false advertising. And of course, the picture is very muddied. If you look at a packet of coffee, it doesn't tell you whether it's mass balance or not. And in fact, each of the schemes have different approaches to it. I'm still not entirely clear exactly what the different approaches are of the different schemes, even though I have spoken to them. But for example, this model you can see on the left here, that is from Rainforest Alliance. They do what they call controlled blending. This means you keep the beans separate right up until the coffee is roasted, but it's stated clearly on the packet, these are not 100% certified beans. You can buy 100% certified trace back to the farm, but you have to look for it. So all of that confusion undermines the credibility of certification. The other big issue is premiums paid for certified coffee. Each scheme offers different premiums to farmers who meet certification standards. This varies from a fixed minimum price paid by fair trade, which then becomes a premium if it goes above a certain price, to a flexible premium paid by UTZ, which is recalculated every year to reflect market prices. The problem is the way this scheme has been rolled out across Africa. Farmers have begun to focus obsessively on the premium, rather than on better farming practices, which is of course what certification is about, and also environmental degradation, and also supporting local communities, etc. More worryingly, demand for certified coffee beans has been very uneven in Africa. This year, I've spoken to cocoa farmers in Côte d'Ivoire and Nigeria, coffee farmers in Côte d'Ivoire and Cameroon, and they're all telling me the same thing. Last season, they were unable to sell their certified coffee and cocoa at a premium. There wasn't the demand for it. And they had to sell all of it as conventional coffee and cocoa, which means all the extra effort they put in received no reward. Considering that farmers do most of the work to produce certified coffee, this is a major disincentive to join certification schemes and raises questions about its long-term viability. In my own view, in the long run, a premium must be paid, either by the off-taker, the consumer, the roaster, to justify the farmer's time and cost to certify his beans. But how you make this sustainable, well, that's open to question. Another opportunity for Africa's coffee sector, and the one I would like to finish off talking about, is commodity exchanges. These could transform the marketing of coffee, and in the process, the livelihoods of smallholder producers. There are dozens of commodity exchanges in operation across the world. The best known, of course, is Bovespa in Brazil. There's also the SAFEX in South Africa. But in Middle Africa, the most striking example is the Ethiopia Commodity Exchange, the ECX. The ECX was created in 2008 as a partnership between market players, members of the exchange, and the Ethiopian government. The ECX trading floor handles more than 200 spot contracts in coffee, maize, wheat, sesame, and haricot. In 2010-11, 500,000 tons of commodities were traded. Around half of that was coffee. The ECX is backed by an extensive warehousing system, upcountry and in Addis Ababa, as this map shows, and there is a warehouse receipt system which frees up financing. A well-run exchange with an extensive warehousing network and with efficient collateral management, of course, can be a catalyst for engaging smallholders and integrating them into the value chain. The key benefit of an exchange to farmers is that it gives them another option for marketing their crop. If they don't want to accept a poor price at the farm gate, they can transport it to the exchange's warehouses. But an exchange also enables farmers to invest in inputs because they can raise money from their crop through the warehouse receipt system. As soon as they deposit their crop, it's graded, a receipt is issued, and any bank will advance them financing against that. Provided the warehouse receipts are issued by reliable warehouses, banks will finance them. And that means that farmers can buy inputs. A commodity exchange also benefits farmers by giving them dynamic price discovery with daily prices rather than infrequent auction prices, which can move enormously from month to month. This can help them to decide whether they should take the price offered at the farm gate or pay the cost of transporting the beans to the warehouse for a better price. Commodity exchanges also help reduce wastage. Typically, 40% of Africa's agricultural output is wasted. It rots either in the fields or poorly stored. If you give farmers somewhere to store it close to their farm, you can immediately reduce wastage. But a commodity exchange is no panacea. The Nairobi Coffee Exchange, which trades around 85% of Kenya's coffee, is a case in point. The exchange was created with the explicit aim of increasing price transparency with regular prices and also making the marketing of coffee more dynamic. But it has been beset by problems, notably corruption. In March 2012, the auction was suspended after complaints by sellers of abuse of the coffee sampling system. The way it worked on the NCE was all licensed exporters are entitled to 14 kilogram samples of coffee on sale, which they can use for testing and quality assurance. However, a number of fraudsters, bogus dealers, got licenses to trade on the exchange, took the coffee samples and simply sold them themselves without actually trading. And in fact, several inactive dealers got several licenses. So they started to build up huge volumes of coffee. A point came eventually when the suppliers who were putting coffee on the exchange says, hold on, we're not going to give you any more coffee here. This is ridiculous. So they suspended the exchange and they did an audit of registered traders. They discovered just 29 out of 118 registered dealers were actually trading on the exchange. And of those, only 14 of them once per month. So the others have since lost their licenses. But more recently, in February this year, a dispute between producers and county governments led to a boycott of the auction. Producers want to sell their coffee directly to traders and roasters, but county governments want to cut out the middlemen and take over responsibility themselves for milling and marketing the coffee produced within their jurisdictions. The government stepped in, it's promised a review of the marketing of coffee in Kenya, and the auctions have resumed for the time being. But the dispute is still festering. Ultimately, to succeed, a commodity exchange needs to reach critical mass. This means trading a high volume and variety of commodities, not just coffee, but also attracting traders to use the exchange as part of their trading strategy. And they will only do this if the exchange has a robust warehousing system and good collateral management, which ensures the quality of the stocks and builds trust in the warehouse receipt system and the contracts issued by the exchange. But there is one final opportunity which is often overlooked, and namely this is African demand for coffee. As we've seen, Africans, with the exception of Ethiopia, consume little of the coffee they produce. But this is changing, as rising urbanization and increasing purchasing power transform African diets and spending patterns. According to projections by Bank of America Merrill Lynch, spending on food in Accra, Lagos, and Nairobi will rise from $2 billion in 2012 to $6.7 billion by 2022. That's the first two bars there on the left. This implies a consummate rise in coffee consumption, especially as Africa's urban population adopts increasingly Western eating habits. The African producers who benefit from this rising consumption will be those who invest in research and development to develop coffee products that suit African tastes, habits, and cultures. If Africans can develop a taste for own coffee, they can finally break free from their dependence on Western markets and develop alternative sources of demand within the region.